Welcome back to this channel. This is Unfiltered Forex. Yours truly, Clement. Today, we'll be looking at pros and cons of fundamental analysis in day trading, presented by me. Introduction. The effectiveness of fundamental analysis in day trading depends on one's own skills, experience, and ability to interpret market info correctly and apply it with great mastery. Just like in technical analysis, it will take a while for a learner to grasp fundamental concepts and apply them effectively. In this video, I'll look at the major pros and cons of fundamental analysis and how its limitations can be used to one's advantage. We'll see that later in the presentation. So, before we start, I'd like you to understand that the effectiveness of fundamental analysis is greatly dependent on a lot of features: one's own skills, experience, and ability to interpret market info correctly, and of course the application. When it comes to the skills, these are pre-existing skills you have about how the market works, pre-existing knowledge on various macroeconomic subjects. Anyway, it depends on a lot of that stuff. Pros. Number one, we'll start with the pros, then finish up with the cons. Help you make more informed trading decisions. By understanding the economic factors that are driving currency prices, you can make more informed trading decisions. This can help you avoid making costly mistakes and to increase your chances of success. Often, markets will move in anticipation of a certain indicator or report due to be released at a later time. Economic indicators are a catalyst for the largest price and volume movements. For example, the most common economic releases like the US CPI and the US NFPs bring about significant price jumps. This is one very major pro of knowing fundamental analysis. Just knowing the economic calendar, to be specific, because the economic calendar, that's where economic indicators are listed. When the time they will be released is listed there. And during such times, in anticipation of a certain indicator to be released at a later time, that anticipation, there are usually big moves prior to the release and afterwards, even prior to the release, during the release, and afterwards. That's common with these big releases: the CPI, the NFPs, and even interest rate decisions. The market moves in anticipation of these indicators. This can help you avoid making costly mistakes and to increase your chances of success. Okay, trading in these markets without knowing about the economic calendar, I look at it like trying to cross a road blindfolded. You get, it's not impossible, but if you are blindfolded between crossing the road during the day and during the night, you would prefer during the night because there are less cars, and there are less cars as opposed to during the day. It's the same here with these fundamentals, with this important reason to know about fundamentals. Helps you avoid making costly mistakes that are often very avoidable and to increase your chances of success. If you know the CPI is coming out in the next 3 hours, or there's an interest rate decision in the next 3 hours in the pair you're trading, that's very likely to make you avoid making a costly mistake like trading on lower time frames like the M15s, because these releases usually bring about the largest price and volume movements. So that's it for this one. Help you make more informed trading decisions. Number two, useful in identifying long-term trends. Fundamental analysis can be used to identify long-term trends in currency pairs. This can be helpful if you're looking to trade currencies for the long term, swing trading and long holding. For short-term trading, once you've identified that a certain pair will be bullish or bearish for the long term, then it would make sense to trade the trend you have identified from a long term perspective. That's what's called top down analysis, I believe. Top down analysis is where you look at a chart from the weekly time frame, you go to daily time frame, then H4, then hourly, then the M15 or M30 entries. Some even go to the minute time frame. Yes, understanding fundamental analysis will help you identify long-term trends. For example, the difference the difference between an interest rate hike and the other one, there's usually a trend. This is for the CPI. No, not the CPI. This is for the US. The US Federal Reserve. Between the time they hike rates today and the next time they will hike rates again, there's usually a trend on the USD pairs. More so the Euro USD, the EU, the Euro USD. There's usually a clear trend between the two rate hikes. That's why fundamental analysis is useful to help you identify the long term trends of what price is going to do between this one rate hike and the next one. That's where it becomes very useful to understand fundamental analysis, and identifying that trend will be useful for short term trading, because if you know, usually the difference between one interest rate hike and the next, or one FOMC meeting and the next, is just some few weeks, not many weeks. The other one, the most recent one we got for June, and then there's a meeting in July. The difference is a month, right? The other one before July was on May. Was it? Yeah, it was on May, early May. The difference there was also 1 month. So there is usually a trend in between the rate hike increases. In between these other releases like the NFPs and the CPIs, these are just minor releases to provide the volatility that the interest rate hike had already started. Volatility to take price throughout through the trend that the interest rate hike has already started before we get to the next FOMC meeting, the next interest rate decision. That was it for this one. Identifying long-term trends. Number three, fundamental event impact helps you to identify significant events and news that can have a substantial impact on currency values. Economic data releases, central bank announcements, and political developments can create trading opportunities based on their influence on market sentiment and expectations. For this one, I look at it as a way of monetizing knowledge. For example, if you have knowledge about the OPEC plus oil production cuts, then you know to expect oil price increases for the next few months due to limited supply. That knowledge combined with some technical analysis can help you look for long-term buy entries and make good profits in the long run. This is why we bring about the topic of geopolitics. Have a big fundamental events like geopolitical events have a big impact on the home currency, where there is chaos or where there is turmoil or where there's something good about to happen. That geopolitical stuff usually has a significant effect on currency values. But for this one, it's usually long term, not short term. It's a very important skill to have when you are able to identify such news like OPEC oil production cuts, and then you know how to react to that release how that release is going to affect prices in the next few months or weeks. That of course is a very big advantage of knowing fundamental analysis. That knowledge combined with technical analysis can help you look for long-term entries and make a good profit in the long run. That's it for that one. Risk management. Number 4. Fundamental analysis helps traders assess and manage risks associated with currency trading. By analyzing economic indicators and political stability, traders can gauge potential risks and adjust their positions or strategies accordingly to mitigate potential losses. For day trading, economic indicators are a catalyst for the largest price and volume movements. For example, the most common economic releases, US CPI and then NFPs and interest rate decisions, bring about significant price jumps. Knowing about these events prior to their occurrence helps a day trader manage risk effectively some hours prior to the release. Yeah, this is where I did talk about when I was talking about the first advantage of fundamental analysis. Now, here at number 4 again, risk management, right? Knowing knowing about these releases, knowing about the NFPs can help you manage your risk better because they bring about significant price jumps. Therefore, if you're in a trade and you can see from the economic calendar that the CPI or there's an interest rate decision coming in a few minutes, in the next few hours, then you know how to adjust your trade accordingly to prevent a premature stop loss or to prevent your account from blowing if you're not the type to use a stop loss. Risk management, right? Usually I advise guys for this one, if you do not understand fundamentals, but you can look at the economic calendar and see the CPI and the NFPs are coming in a few. If you're in a position, what you do is you take partial profits, then move your stop loss to break even. That's if your broker usually doesn't have big slippage. Big slippage is a very big problem when trading the news. But of course, you know your broker, you understand what happens, and you need to manage your risk effectively when you see there's a big release coming. That's how fundamental analysis can help a day trader in risk management. Knowing about these events prior to their occurrence and knowing the significant price jumps they cause will help you make a more informed decision, will help you manage your risk well when the time comes or the day before the releases, you know. Now let's go to the cons. These are the disadvantages of fundamental analysis. Yes, there are disadvantages. Time consuming. Fundamental analysis requires extensive research, analysis, and monitoring of economic indicators, political events, and other factors. It can be time consuming, especially for individual traders who may not have access to the same resources as institutional traders. However, choosing an approach that best fits day trading, which is analyzing economic indicators only, is less time consuming as opposed to looking at the broader picture of all factors that affect prices. This is an obvious disadvantage of fundamental analysis. It's usually considered time consuming. Time consuming because you have to do extensive research and analysis to monitor these economic indicators and political events. But if you're a day trader, you should focus on the economic indicators only because these are the ones that usually have a both short-term and long-term effects. If you saw my previous video on types of fundamental analysis, then you might have understood something that about this. Economic indicators like inflation, interest rates, jobs reports, that kind of stuff. Those are the ones that have a short term effect on price and they are usually easy to decipher. You don't need a lot of time to analyze them, but you still need to dedicate uh, a significant amount of time to do this. Keeping up with market events is very important to do that. And individual traders who may not have access to same resources as institutional traders. This is something where now, even as I said in the previous video about types of fundamental analysis, and even when I was talking about economic uh, when I was talking about the types of fundamental analysis, I did say there are currency pairs which you should focus on when you're trading fundamentals, because the resources are easily available, right? You can get a lot of data from other analysts, you can get a lot of info about how the economy is doing, you can get a lot of interpretations, you can get very many resources to help you trade fundamentals effectively. You just don't have to, you just need to trade the right pairs, and I did list them. The USD and the Euro, those are the best ones for this kind of thing, this kind of fundamental analysis. Even the stock market is good, but that's good for to some extent. That's a very big limitation. Okay, let me continue. Number two, delayed price adjustment. There can be a time lag between the release of new information and its impact on currency values, making it challenging to time trade solely based on fundamental analysis. Often you hear the quote, buy the rumor, sell the news. This is it. There is usually a time lag between when a release happens and when it starts to take effect on the market. Sometimes the news is priced in way before the announcement itself. Now, this is forward price adjustment. This is the place where, for day trading, it needs a different set of skills to understand how the news will affect prices in the short term. This disadvantage of delayed price adjustment, it usually affects people quite a lot. I have met traders who have a big problem trading fundamental analysis because of this thing, delayed price adjustment and forward price adjustment. Sometimes a news release will happen and you see the move is not as big as you expected it to be. Why? Because of these things, forward price adjustment. The news was already priced in even before the announcement itself. And that's where it needs a different set of skills. It needs a lot of experience with these markets to understand when forward price adjustment happens, to understand when it's a delayed price adjustment is going to happen, to understand these things. The more common one is with economic indicators, the more common one is forward price adjustment. The releases like the CPI, the interest rate decisions, the jobs report, often they are usually priced in, sometimes they are priced in even before the announcement itself, forward price adjustment. Delayed price adjustment, this is very common with interest rate decision. Interest rate decisions have a short term and long term effect on the currency pair. That's where this delayed price adjustment comes in. If you want to trade fundamental analysis, again, it's time consuming to understand how these two factors are going to, how when these two events are going to happen, delayed and forward price adjustment. Let's continue. Number three, complex interactions. The forex market is influenced by a wide range of interconnected factors, making it challenging to accurately interpret their impact on currency values. Factors such as economic indicators, political events, market sentiment, and global economic trends interact in complex ways, requiring a deep understanding and analysis of multiple variables. True, on the surface layer, there are only a few known market variables, but deeper into the rabbit hole, a deeper understanding is needed to apply fundamental analysis to day trading. Yeah, complex interactions. As I have said, above here, delayed price and forward price adjustment. Understanding these things, it's very complex. It's not as easy as one plus one. No, it's very time consuming, and it needs a lot of skill, a lot of dedication to learn these things. Complex interactions. A deeper understanding is needed to apply fundamental analysis to day trading, like on a large scale, like consistently. If you want to trade fundamental analysis like I do and be profitable doing it almost all the time, you need a deeper understanding as opposed to the tip of the iceberg understanding that most traders have. Deeper, the the whole iceberg underneath requires a very deep understanding to understand how fundamental events, how economic indicators are going to affect prices in the short term and in the long term. Number four, subjectivity. This is very important. Fundamental analysis involves making subjective judgments based on the interpretation of data and events. Different analysts may have varying perspectives on the same information, leading to differences in conclusions and predictions. This subjectivity can introduce a level of uncertainty and make it difficult to forecast a short-term price movement. This is true. If you have an experience with fundamental analysis, you know this is very true. Someone thinks the CPI is going to come out above estimate. Someone else is saying the CPI is going to come out below estimates. Both these people, they are very senior people at the kind of jobs they do. So it's very hard to come to a correct conclusion. This subjectivity is very hard. It's very hard to apply it to forecast a short-term price movement. It's very hard in the beginning, of course, but with experience, as you go learning these things, you're going to see how to effectively apply the knowledge of fundamental analysis into forecasting a short term price movement and being correct most of the times, almost all of the times. As I said earlier, you only need to focus on economic indicators mostly, economic calendar, the CPIs, inflation readings, interest rate decisions, jobs numbers, and for the US, there's even the jobless claims, the PMIs, the ISM PMIs, there are several. So you need to understand economic indicators mostly to forecast a short-term price movement. Geopolitical events are only affect prices in the long term. Only affect prices in the long term. Okay. Conclusion. I am done already. The decision on whether fundamental analysis is a good pick narrows down to one's own preference and natural interest. For some people like me, the cons are fewer and the pros are more. Personally, I'm studying economics in school, therefore, it is easier for me to apply the pre existing skills and knowledge I have to effectively carry out fundamental analysis as opposed to someone who is just starting out in this field with no prior knowledge on economics and macroeconomic phenomena. I find it easier to trade fundamentals more so following the economic calendar because it gives me a clear time window of when to expect volatility and the bias. Then the technical analysis gives me the technical location of where to expect that volatility. No chatbox examples have been shown here since this was just summary of the pros and cons. Yes, this was just a summary. I didn't intend to make it very long talking about these things. No, since this is a YouTube channel I've dedicated to this kind of content, there will be more videos talking about how these things can be applied in day trading, how fundamentals can be applied in day trading. And as you can see here, it is a very personal preference. This is just a preference depending on your natural interest and your brain, how you're built, the things you understand easily more than the others. Personally, I am a mathematician. I like economics. So this part of natural interest is what makes me decide to focus on fundamental analysis in itself. I just find economics interesting to look at. Therefore, I do this thing, fundamental analysis, more than the technical part. Understanding macroeconomic phenomena is also important, as you've heard me talk about geopolitics, interest rate decisions, the inflation readings. All those are macroeconomic phenomena. And if you do not have pre existing skills and knowledge, that's where now it becomes very time consuming for you because you have to learn, you have to start out new, fresh, and start learning these things from the basics of the basics. I have a video for that. You start learning these things from the basics, going deeper into the rabbit hole, going, seeing under the iceberg of macroeconomic phenomena that affect price in the long term and in the short term. That was it. Thank you for watching. This is the end. I will release more videos later talking about these things. But for this one, the pros and cons of fundamental analysis, it ends here. Thank you for watching.